So we're going to continue on from chapter 2. We were talking about fixed and variable cost. So in this example here, variable costs increase with volume. So if you're a hotel and you provide some toiletries and snacks like cookies in the room, obviously the more hotel guests you have, the more of that stuff you're going to use. Whereas fixed costs remain constant regardless of changes in volume. So if a hotel is leasing its building, then whether they're hosting 100 guests or 500 guests, the annual lease cost remains the same. So relevant range is a range in which the total cost remain constant and the variable cost per unit remain constant. So in the hotel example, so if the hotel has a capacity for 500 guests, but then the demand is higher and they decide to lease, say, another hotel, that's a situation where the fixed costs would then increase. But the costs are fixed up to a maximum of 500. And another interesting thing can happen here as well. So if the volume of toiletries, like the little soaps and things you see in the rooms, if that increases to the point where a company qualifies for a volume discount, then the variable cost per guest could actually decrease if they're getting some sort of volume discount. So oftentimes costs have both fixed and variable components. So if a hotel, say, was completely empty, think about COVID-19 when nobody was traveling, they're still going to have to pay their utilities every week. They got to pay to heat and keep the electricity on there. So these costs, if you're dividing them out over your 500 guests, you're going to have a cost per guest. So looking at say a fitness company, so a Fitness for Life, so say their operating costs were $10,000 per month and they had variable cost of $1 per member per month, and their existing facilities could serve up to 750 members. So there's a schedule you can complete, and this is pretty common in business to do a schedule to figure out how much your costs are going to be if you only have 100 members, 500, or the max 750. So then we know that for 100 members, the variable cost per member, it's $1. So it's always going to be $1 times the number of members. Whereas your fixed costs remain the same right up to 750 members. So your variable cost is $1, and then your fixed cost, if you try to average out that fixed cost on a per member basis, it's going to look like your fixed costs are coming down. They're not, but all you're doing here is you're dividing your fixed cost, your 10,000, over your 750 members. So it makes it look like, your fixed costs are going down, but they're not. You're just allocating it out over more members. So when you're looking at how costs behave, there's 4 basic ways to do that. So one is account analysis, the other is a scatter plot, high-low method, and regression. So with account analysis, basically you're just looking at the transactions in your accounting system and you're using your judgment and estimating as to what proportion is fixed, what proportion is variable or mixed. And this requires a pretty in-depth knowledge of the business and the nature of its operations. It can also be a bit subjective because you could have 2 people looking at the same transactions in their accounts and come to different conclusions as to variable, fixed, and mixed. Particularly the mixed, that one is a little bit trickier. So a more accurate way of doing it is to plot some historical information on a graph. And here you plot your historical cost data on the y-axis and the volume data on the x-axis. So this shows the user visually the relationship between cost and volume. So it's more of a visual, it's more accurate than looking at your accounts, a visual look at your accounts. It provides you a bit more information, but it's still not extremely accurate. The two other methods are more accurate, and it's called the high-low method and regression analysis method. So I have some demonstration videos in the Chapter 3 folder that will show you how you can calculate these various costs using the high-low method and the regression analysis method. So you should review those videos. You can display your information in a couple of different ways. So this option here is the traditional income statement, where you have your revenue less your cost of goods sold, gives you gross profit, then your operating costs. So in the cost of goods sold, that's just the cost of the products that you've sold. And then the operating cost is typically all of the other, like your management CEO salary and insurance and depreciation, all of that sort of thing is operating costs. So you come down to an operating income of $10,600. So another way, other than the traditional way of displaying your income statement, you can do a contribution margin income statement. The sales don't change and the operating income stays the same. It's just how you're presenting the information. So in a contribution margin format, you have your sales revenue, less all your variable expenses, so that's your materials and your labor and your overhead. That gives you your contribution margin. Then you subtract your fixed costs. So those are the costs that don't change, you know, the insurance, property taxes, etc. And you still end up, of course, with the same operating income. But what this shows you here is how much you're making, your contribution, that's over and above your fixed costs. So if you had a bad downturn in your business, you know that you have to make, your contribution margin has to be at least $11,000 just to cover your fixed cost. So that's a target to keep in mind. If say you're going to have a big sale, you got a lot of inventory, you want to, get the stuff out of your building, and you reduce your selling price, you got to keep in mind that you got to make at least $11,000 just to break even. So another way to look at your information is through variable costing versus absorption costing. So variable costing includes only the variable manufacturing costs. So it's the direct materials, direct labor, and your variable manufacturing overhead. Your fixed manufacturing overhead is considered to be a period cost. So that's the cost, say, to lease your building or to pay the insurance, etc. Variable costing is for internal use only. You do not use that for external reporting. But it can give you a lot more information to help management make decisions. Absorption costing, here all the manufacturing costs to make the product are included. And the main difference here is that your manufacturing costs includes both variable manufacturing overhead and fixed manufacturing overhead. So what you're doing here is you're absorbing your fixed manufacturing overhead into the cost of making your products. That's the only difference between the two methods, variable versus absorption. So here, for your traditional income statement, all product costs, both fixed and variable manufacturing overhead, as well as direct material, direct labor, is included in all inventoriable cost. So that would be what you would do for your traditional income statement. So when, again, this is just another way to think about your absorption and variable costing. So when you look at your categories, materials are the same, direct labor is the same, variable manufacturing overhead is the same, but for absorption, you are including the fixed manufacturing overhead as part of the product cost, whereas under variable costing, it's over here as a period cost. So that's the difference. Absorption costing is used for external reporting for your year-end financial statements, but variable costing, you'd use that internally, and you would use your contribution margin income statement for that. Another factor to consider about cost is those that are traceable costs versus common fixed costs. So fixed costs are often allocated on the traditional income statement, but they can lead to sort of false assumptions, such as the belief that elimination of a segment would result in greater profits. So common fixed costs, so the costs, for example, of leasing your building, that's not going to change if you decide to drop a product line, to drop a segment. You're still going to have to pay that, regardless if you make, 5 products or 10 products. So the common fixed costs that are going to be there anyway, regardless of what you do, you shouldn't be using that in evaluating a segment performance. So only traceable fixed costs could be eliminated if a segment is dropped. So if it's a fixed cost, but it's directly related to a particular product or segment, then that could be a cost savings if you drop that particular product or segment. So when you're looking at segmented income statement, what you're doing here is you're breaking down, in terms of this example for the Maplewood Equestrian Center, you're breaking down their business into the 2 major segments that they have. They offer boarding for the horses and then horse riding lessons. So you can see here the segment margin is how much each of these 2 divisions are making for the company. Down here you see the $167,000, that's the common cost. So if you gave up the boarding part, you're not going to save any money here. You're still going to have this $167,000 common cost, because you've got the cost of renting those stables and for the insurance and so on for that. So what we're doing here is you have your contribution margin, so your variable materials, your direct labor, and your variable overhead. That's included in variable costs. So that gives you a contribution margin. Then in addition, there's some fixed cost that can be traced. So you can, in this particular situation, you can trace $27,000 to boarding and $45,000 to lessons. So this shows you how much each segment is making. So that concludes the overview for Chapter 3.